When it comes to investing in the stock market, there are two main types of funds that people can choose from: index funds and actively managed funds. It's important to understand the differences between these two types of funds in order to make an informed decision about which one is right for you. Index funds are designed to track the performance of a specific market index, like the S&P 500. They invest in the same stocks as the index they're tracking, and they aim to match the returns of that index. Because index funds are passively managed, they tend to have lower fees and expenses than actively managed funds. Actively managed funds, on the other hand, are designed to outperform the market. They are managed by professional fund managers who research and analyze stocks in order to make investment decisions. Because actively managed funds require more resources to manage, they tend to have higher fees and expenses than index funds. In terms of performance, index funds and actively managed funds have different strengths and weaknesses. Index funds tend to perform well in bull markets, when the overall market is rising. However, they may underperform in bear markets, when the market is falling. Actively managed funds, on the other hand, have the potential to outperform the market in both bull and bear markets, but they also have a higher risk of underperforming. Overall, the choice between index funds and actively managed funds depends on your investment strategy and risk tolerance. If you're looking for a low-cost, low-risk way to invest in the market, index funds may be the better choice. However, if you're willing to take on more risk in order to potentially earn higher returns, actively managed. When it comes to investing in index funds or actively managed funds, it's important to evaluate the pros and cons of each type of fund and determine which aligns with your personal investment goals and risk tolerance. Let's start by discussing index funds. One of the biggest advantages of index funds is that they offer low fees. This is because index funds simply track a market index, like the S&P 500, rather than actively trying to outperform it. The other advantage is that index funds are generally more tax efficient, as they have lower turnover rates and generate fewer capital gains. However, there are also some disadvantages to index funds. Because they simply track a market index, they don't offer the potential for outperformance that actively managed funds do. Additionally, because index funds are diversified across a specific index, they may not be as diversified as some investors would like. Now let's move on to actively managed funds. The biggest advantage of actively managed funds is that they offer the potential for outperformance. Because the fund manager is actively selecting investments and making decisions about when to buy and sell, there is the potential to beat the market. However, there are also some disadvantages to actively managed funds. One of the biggest is that they often have higher fees than index funds, as the fund manager is actively making investment decisions. Additionally, actively managed funds can be more tax inefficient, as they tend to have higher turnover rates and generate more capital gains. So, how do you determine which type of fund aligns with your personal investment goals and risk tolerance? It's important to consider factors like your investment objectives, time horizon, and risk tolerance. If you're looking for a low-cost, diversified investment option and are comfortable with market returns, index funds may be a good fit. On the other hand, if you're willing to pay higher fees for the potential for outperformance and are comfortable with the risks involved, actively managed funds may be a better fit. Ultimately, there is no. Now, let's dive into the meat of the debate between index funds and actively managed funds: their historical performance. When it comes to investing, one of the most critical factors to consider is how the investment has performed over time. This is where historical data comes into play. By analyzing the long-term returns of index funds and actively managed funds, we can gain valuable insights into which type of fund may be more suitable for our investment goals. Index funds are known for their low-cost structure, which is one of their primary advantages. But what about their long-term returns? Well, studies have shown that index funds have consistently outperformed actively managed funds over the long run. This is largely due to their passive investment strategy, which involves tracking a specific market index, such as the S&P 500. Since index funds don't require active management, they tend to have lower expenses, which translates into higher returns for investors. On the other hand, actively managed funds are designed to beat the market by using a variety of investment strategies, such as picking individual stocks or timing the market. While this approach may sound appealing, the reality is that the vast majority of actively managed funds underperform their benchmarks over the long haul. In fact, studies have shown that only a small percentage of actively managed funds consistently beat their benchmarks over time. So, what does all of this mean for investors? Well, it suggests that index funds may be a better choice for those looking for a more passive, low-cost investment approach, while actively managed funds may be more suitable for those willing to take on higher risk in pursuit of potentially higher returns. However, it's important to note that past performance is not a guarantee of future results. While historical data can provide valuable insights into how a fund has performed in the past, it's not a crystal ball that can predict how it will perform in the future. So, when evaluating a fund, it's essential to consider a variety of factors, including investment strategy, fees. When it comes to investing in mutual funds, one of the most important factors to consider is the fees and expenses associated with them. These fees are what fund managers charge to manage the fund and can include things like administrative fees, marketing expenses, and investment advisory fees. The expense ratio of a fund is the percentage of the fund's assets that are used to cover these fees. It's important to note that even a small difference in expense ratios can have a significant impact on your investment returns over time. Actively managed funds tend to have higher expense ratios than index funds because of the higher costs associated with the fund manager's active management. This means that you may be paying more in fees for the potential of higher returns. However, studies have shown that the majority of actively managed funds underperform their benchmarks over the long term. On the other hand, index funds have lower expense ratios because they simply track a benchmark index and require little active management. This means that you could be paying much less in fees for similar returns to actively managed funds. When selecting a mutual fund, it's important to consider the expense ratio and look for funds with low costs. This will help to maximize your potential returns over time. In addition, it's important to remember that fees are not the only factor to consider when selecting a fund. It's also important to consider the fund's historical performance, the investment strategy, and your personal investment goals and risk tolerance. By carefully evaluating all of these factors, you can select the mutual fund that is right for you and your investment portfolio. Now that we have discussed the differences in pros and cons of index funds and actively managed funds, let's talk about how to create a diversified investment portfolio that incorporates both types of funds. First, it's important to understand that both index funds and actively managed funds can play an important role in a well-diversified portfolio. Index funds provide broad exposure to a market or sector, while actively managed funds can offer the potential for higher returns through the expertise of a professional fund manager. When deciding on the appropriate mix of index funds and actively managed funds, it's important to consider your personal investment goals and risk tolerance. For example, if you are a conservative investor who is primarily focused on long-term growth and stability, you may want to consider a larger allocation to index funds. On the other hand, if you are a more aggressive investor who is willing to take on more risk for the potential of higher returns, you may want to consider a larger allocation to actively managed funds. It's also important to consider the fees and expenses associated with each type of fund. Index funds typically have lower expense ratios than actively managed funds, which can make them a more cost-effective option for investors who are looking to minimize fees. When building a diversified portfolio that incorporates both index funds and actively managed funds, consider allocating a larger percentage of your portfolio to index funds and a smaller percentage to actively managed funds. This can help to balance out the potential risks and rewards of each type of fund, while still providing exposure to a wide range of assets and sectors. Ultimately, the key to building a successful investment portfolio is to carefully consider your individual investment goals and risk tolerance, and to work with a financial advisor who can help you develop a customized investment strategy that meets your needs. By taking a thoughtful and strategic approach to investing, you can help to maximize your potential returns and achieve your long-term financial